Hello guys, if you are someone who is just starting up your forex trading, then this will give you everything you need to understand about the basics of forex and take you down your path to becoming a profitable trader. While if you are someone who is already trading, chances are you probably missed this part, right? And if you do, that's a damn shame because it's gonna be likely impossible for you to become a profitable trader without the things I'm going to show you in this lesson. So whether you are someone who is just starting up your forex trading career or someone who is already trading, let's make sure we have a solid foundation on today's video with the basics of forex. So since I will be doing that for free, why not go hit the smash the subscribe button, like, hit the notification bell, so whenever I drop a new video, you will be notified instantly. So the first question today is, what is forex? If I were to ask you what is forex, what will you say? Well, let me cut you short. Forex trading is the largest market in the world. And what does that mean? How big do you have to be to become the largest market in the world? Well, you see, on an average trading day, Forex trade no less than $5 trillion. You see why it's the biggest market in the world. So the next we are going over to is currency pairs. What's currency pairs? Currency pair is nothing more than exchange rate between two currency. We all have traveled at least. We all have exchanged money at least. But if you haven't, then if you have traveled outside your country, then you have probably exchanged money from one currency to another. Let's say you live in the United States and you take a trip to Europe. You are mostly likely to exchange some of your USDT to Euro, and the exchange rate is what you will get. So let's say right now the Euro USD exchange rate is, let's do a little example, 1.0860. So, and you want to get €1, that simply means you will be giving them $1.0860 to get €1. Are you getting me? The way we actually trade this is when this exchange rate goes up and down. You see, that's how we actually trade this. Let's say the euro goes up in value. That means you will be needing more than 1.0860 to get €1. But if the euro goes down in value, you will be needing less dollar to get €1. So that's it. It is what it is. And the way we actually made money is when this exchange rate rise and fall, going up or down. Next we will be going into is currency pairs. So let's delve into that and see what we have to say about that. All these are currency pairs, all these except US, AUUSD and US30. All these are currency pairs. You see right here. These are currency pairs, top major currency pairs. That's what you are seeing right here. Each currency pairs are made up of different currency. And the first thing you need to know is what each three-letter symbol represents in each currency. So each three-letter symbol we have that represents a certain country and currency. So with that being the case, we have one currency value against the other currency value, which is what gives us a better calculation of the value of a specific currency. So as you can see, we are currently in the chart of EuroCAD. We are currently in the chart of USD CAD. So let's say for instance, the USD CAD exchange rate is 1.08. 60. The best way to identify this is that a peep right here from 0 to 1 is a what? That's a 1 peep move. If this market move from 0 to 1, that's 1 peep move. If we move from 0 to 2, that's 2 peep move. Are you getting it? If we move from 0 to 6, if we move from 0 to 6, that's 6 peep move. So if this 6 right here, if this 6 right here move from 6 to 5, that's 10 pip move. If we move from 5, if we move from 5 to from 5 to 7, that's what 10 pip move, because it's in 6 right now and it moved to 5 to 7, that's 10 pip move. If this market move from 6 to 9, that's that's 30 pip move. That's 30 pip move. Sorry, I don't know if you get it, but that's it. If this 0 right here move to 6, that's 6 pip move. If this 6 right here move to 7, 8, 9, that's 30 pip. If this 8 right here move to 9, that means we have moved 100 pip. I don't know if you get it, but if you don't get it, you can go back and rewatch the video again for a better clarification. So you want to each pip move is each pip move right here is 1 pip. Each pip move right here is 10 pip. Each pip move right here is 100 pip. That's how I personally identify a pip. So we will dive into that, give you a proper definition about it so you can be able to understand it whenever you want to go into the market. Thank you. So this is the second way I look at it. So let's say right now, if you were to check which pip change, where is the changes at? If you look at the 0 right here, the 0 is still the same, 6 is still the same, 8 went to 7, 0 is still the same. So right now we move down 100 pip, we drop down 100 pip. Are you seeing it? This is how I personally identify what the market is doing. The market is in 1.0860 before, and it went to 1.0876. The market is in 1.0860 before, but right now it's in 1.08760. So at this point we have dropped down 100p. So what say for instance right now the market move from 1.087 right here to 1.884. What has we done? What has the market done? Here, right here, I told you if this market move 1 pip, we have initially moved 10 pip. So right now the market is in 6, and then the market dropped down to 4. How many people have we dropped down to? We have initially dropped down the market is in six and right now we are in four. So at this point in time, we drop down 20 pip. Are you seeing it? This is how I calculate pip. So when this zero right here, so right now, let's say this market now, let's say this market now, let me, so let's say this market, this zero now, move from, move to 1. How many people have we dropped down to? We have not dropped down. I told you if this market move from 0 to 1, we have dropped down 1 pip. So this 0 right here, if it move 1 pip, if this 10 right here move, that's 100 pip. Are you seeing it? This is the best way I personally identify it. I don't know if you get it, but if you don't get it, you can go back and rewatch the video again. So we dive into the next one. The next right here is what's a peep? If I were to ask you what's a peep, what will you say? Let me cut you the urge of guessing. Listen, a peep is the smallest amount of number you see right here. In this corner right here, a peep is the smallest amount of number that moves in a currency pair, which is all this number you see right here. That actually matters to us whenever we are placing orders. All these numbers right here are matters to us whenever we are placing order. A pip is how we get money or get how we make money or get stopped at depend on how our trading goes. So it's very important to understand what this is. Next we are going to dive into right now is how to identify a pip. How to identify a pip in the market. So we will dive into that and see how it's being done. So let's say for instance, you went to the USD exchange rate and it's showing you something like this 1.0870. Let me space this at 70 right here. So the way we identify a pip is this phone number away from this number right here. That's what's referred to as a pip. We are talking about a pip from all currency pairs except currency JPY. Any currency pairs that has currency JPY in it will be slightly different from this currency. This pip I just show you right now. So for every currency pair that doesn't have currency JPY on it, the last phone number is what is referred to as a pip. So let's say for instance right now, we have the Euro USD exchange rate at the rate of 1.08670. So what if the market move from 1.0870 to 1.0871? So right now the market is in 1.0870 before and it moved to 1.0871. So how many people have we dropped that to? So if you could remember the last place I told you, I say a pip from 0 to 1 is a 1 pip move, and a pip from 7 to 8 is a 10 pip move, and a pip from 8 to 7 from 8 to 7 is a 7 pip move. So right now the market is in 0 before and it did what? It went to 1. So initially we have dropped down 1 pip. You see, so if you could think about it for the previous example I gave you, it's very easy to identify pip. So let's do another example right now. So let's say this market move from 1.08 70 let me clean this one first to 1.0670. So right now, how many people have we dropped down to? The 0 is still the same, the 7 is still the same, the 8 moved to 6, and the 0 is still right there. So how many people have we dropped down to? Just like the previous example I told you, right here is 100 pip. So if the market move from 8 to 6, that means we have initially dropped down 200 pip stop loss, 200 pip. So we want to be aligned with the volatility of the market, and the pips. We want to be aligned with the pips to be able to get good results from your trading. So it is what it is. That's the easy way I identify pip. So we jump up to the next one. Hello guys. So just like I told you in the previous example, I told you any pairs that has currency JPY in it will be slightly different. So we will dive into the JPY analysis right now and identify it and decide and know how to identify a pip whenever you are in JPY or other currency pair. So at this point in time now we have done other currency pair. So right now this is at the to identify a pip. I told you any currency pairs that is in JPY is slightly different. So we will dive into it and know how to identify a pip right away. So a pip from 1.0. So let's say right now the market is in 1.101.166. So at this point in time, if this market right here move 1 pip, if we move from 6 to 5, we have initially dropped down 1 pip. And if this is right here move from 6 to 5 or 4, we have initially dropped down 10 pip. While if this one right here move from 1 to 2, or 3, if you move from 1 to 2, we have initially dropped down 100 pip. When I'm talking about this. So if this one right here move to 2, we have dropped down 100 pip. If this is right here move to 5, we have dropped down 10 pip. Where on this end right here, if this one is right here move to 5, we have dropped down what, 1 pip. Are you getting it? So if this 6 right here move to 5, we have dropped down 1 pip. We have dropped down 1 pip. If this one right here, this is right here, let me cancel this. If this one right here, if this right here, if this is right here move to 5, what have we done? We have dropped down 10 pip. And if this one right here move to 2, which is what we are seeing right here, that means we have dropped down 100 pip. I don't know if you get it, but if you don't get it, you can go back and rewatch the video. Very simple, something simple and easy. Let me do it again. It's very simple and easy. Let's say right now you see a pip move. See, you can see it right here. This market now, once it move from 6 to 5, we have dropped down 1 pip. Sorry, fuck, that's too big. We have dropped down what? 1 pip. If this 6 right here move to 5, or let's say this 6 move to 4, let me cancel this. If this 6 move to 4, we have dropped down 20 pip. If this one right here move to 2, we have dropped down what? 100 pip. So I don't know if you get it. This is how I personally identify a pip in JPY. So slightly different. It's not really that hard, but if you focus, if you can't find if you don't understand it, go back and rewatch the video. So it is what it is, man. Next, we are going over to is what is the value of a pip. So we dive into that so you understand what's the value of a pip. So when you are trading a standard lot account, you are trading at the value of $10. And that simply means if this market, if you are trading a standard lot size account is an $100,000 account. So each pip move will be you will make sure that you are not losing more than 10 pip. No, if each pip move you move, you are making $10 or losing $10. I don't know if you get it. If you don't get it, you can go back and rewatch the video. Each pip move you are moving, you are not making sure that you are not losing more than $10 or making more than $10. And if you are trading a micro account, you are not reaching $10,000 account, you want to make sure that you are not losing more than $1, which means each pip move you are moving is giving you $1. That's if you are trading $10,000 account. Why if you are trading a micro account, that simply means which is $1,000 account. Each pip move you want to be making is 10 cents. You want to make sure that if you are making move, you want to make 10-cent move, and if you are going down, just like the previous example I give for in the 10,000 and the 100,000 lot. So if you are trading a 100,000 lot account, you want to make sure that each pip move you are taking 10-cent move. So that's it. So we'll jump into the next lesson and show you how it is. So that's it. So let's say right now we are buying Euro USD at the rate of one. We buy Euro USD at the rate of 1.0860, and we buy Euro USD at the rate of 1.0860 in a 100,000 lot size account. So let's say we buy the pairs right here and we move from 1.0860 to 1.0760, just like the previous example I gave you. If you see right there, the 0 is still the same, the 6 is still the same, the 8 moved to 7, the 0. So how many pip move did we just move? We make an 100 pip move. Are you seeing it? This is how we so each pip move you want to be making, you want to be making sure that you are making $10, $1, or 10 cents. Just like so, the market right now you move 100 pip. So at this point, if you calculate it right there, you see we just move 100 pip move. So what if right now, right here, we are in, let's say we move from 1.06, no, let's say we are currently in 1.008, then we move to 1.0 what? 9. How many people have we moved up to? We have initially moved up to 100 people. So that's how you calculate it. You move up to 100 people right here. You see, if you go up, you move up 100 people. If you go down, you want to make sure that each people moving are moving. You are taking 10 people loss or $1, $10 loss or $1 or 10 cents. So that's it. So the same example goes to mini lot and micro lot. So let's say if we are trading $10,000 account, it's the same opposite with the first example I give to you. And if you are trading $1,000 account, it's the same opposite I give to you. So you want to make sure each people it's nothing more than 10, $1 or 10 cents. So yeah, let's dive up to the next one, which is how to identify. Yeah, so the next is how to identify trend. And in their most base form, an uptrend line is nothing more than is nothing more than a trend line that starts from the bottom to the top. And a downtrend line is nothing more that starts from the top to the bottom. It's nothing more than a market that is showing something like this. Low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and so on and so forth. So a trendy market is nothing more than a market that is showing higher highs and higher lows. So that's it for the lesson of a trendy market. Next is, how do you draw trend line? A trend line is said to be valid if it touch at least two pack or two, which means the example I just gave you right now, high, low, higher high. What did the market do? The market reverse, tap into our entry and did what? I start pushing higher. So it's nothing more than a market that usually touch two pack or two, something like that. So we will dive into that, give you the example and everything you need to know about trend identification. And delete this to make it easier to see for you. Next is support and resistance. What support and resistance? A level where market buy or sell from. That's support and resistance. Where a market drop down from or buy from, which means this place we just mark. So let me say right here, the market did what? The market push high, low, higher high. Then what did he do? He pushed down, immediately pushed down, he keep doing what? He keep going up. So the same way is the same way from the opposite. If you are selling, the market will be dropping down. So where the market will drop down from is what is referred to as support and resistance. Your take profit is the resistance, and where you will be buying from is the support. So that's it. And if you drop to the other example right here, you see the market came here, break high, low, higher higher low and did what and start pushing up. You see, so that's it. If you come to this other place right here, the market gave us an impulsive move and did what pull back. What did this pullback do? It broke into new highs, then came back toward our entry. So if we were to put a box right here, this is our support, going into resistance right now. So and did what? And breaking to what? Into new highs. So that's it. That's the best way we identify trend, and that's it. And start keep pushing high. If you came here, you see the market did what? The market break into new highs, came back, break into new highs. Where did this pullback come back into our entry? So if we were to put a position right here, we break what into new highs. So the level of so a trend so a, what are we even in? Support and resistance, a level where market bounce off or be supported by. So it is what it is. That's the best way to identify support and resistance. So let me delete this to make it a little bit easier for you to see. So that's it. Next we are going over to next is a very crucial one, which is only look for buy in an uptrend. As this market is trending up right now, you want to be buying. You want to look for buying opportunity. You don't want to sell. You want to buy this market to the upside as long as the trend keep buying to the upside. Then if the market is selling down, you want to follow the market, you want to follow the trend and sell the market to the downside. So it is what it is. So we will jump in to the next one. Next is when the market break, just like what the market did right now, it break. Next time when the market break, I came into your entry zone right here. The second touch always shoot out aggressively to the upside. That's if you are buying. If you are buying, once the market break into new highs and retrace back to your entry, the market always shoot up aggressively. You see, so you want to be aligned with the trend. Anytime the market come into your entry, you must shoot up aggressively. You want to be intact. You want to make sure that you are not losing any opportunity. Once the opportunity gets to your entry, then you enter. You can check the previous example, which are all this I just analyzed. You can see immediately the market always shoot up aggressively right here. You can see this. So it's not a new thing. So whenever you want your opportunity to be right below, so once the market came down to pick you, you go in because after that place the market shoot up aggressively and you want to be making money along the trend. So that's it. So we will jump to the next one. I don't think this is really relevant, but I should just pour it out. So PIP are calculated in gold. A PIP from 1960.00 to 1965.00 is a 50 PIP move. So you should know that right now. And just because I said most market break and touch your entry zone, you should buy doesn't mean you should buy. You will try to look for a confluence, a confirmation, reasons why you buy the trade. So that if someone asks you what did you see, what are the things you see that make you take the trade, you can be able to say this is what I see, this is what I see, this is what I see. And it's not just one, it's four. You have to see these four confluence before you take any trade. Do well to watch out for candlestick pattern in the entry zone before taking any trade. With that, the confluence will be 4 out of 4, which is trend line, psychological level, support and resistance, and candlestick pattern. So if you check candlestick, these are the things you really need to see. You check where your trend, the overall trend is trending to, where your psychological level is, where you want to take trade at, You will mark this place that if the market did not come to this place, I'm not entering. Are you seeing it? If the market did not come here, I'm not going in. So that's the things you want to know. And if the market have touched the things you really need to see, you want to make sure that you are trading based on support and resistance, which means once the market break, you will test your entry and start going up. You want to follow the market. So that's it. Then what you will be watching out for is candlestick. That's the last one. You need to watch out for candlestick and see where the what has the market give you. If the market has give you double bottom or double top or head and shoulder, something like that, similar thing like that. Yeah. While if you are buying, you want your take profit to be above, and if you are selling, you want your take profit to be below. So if you are buying, your take profit will be above and your stop loss will be below. And if you are selling, your take profit will be below and your stop loss will be above. So if you are selling the market, what you will be looking for once the market touch your zone on the 1 hour, you go to the 15 minute to make sure in 15 minutes you see something like, if so, which means if you are buying, you want to see something like double bottom or head and shoulder pattern. While if you are selling, you want to see something like M pattern. If you went to your 1 hour is to draw out your zone, you want to execute the trade. Then the 15 minutes is to check your trade and check if it align with things you really want to see before you go into the market. So that's it. If you are buying, you want to check out for W pattern and head and shoulder. While if you are selling, you want to check out for M pattern and head and shoulder, something like that, similar thing. So we divert to the next one, which is, remember, I want you to remember this M pattern in your entering is a key level. M pattern in your entry. So if you are selling, you see M pattern in your selling entry. That's a key level. You can go all in. While if you are buying, if you see W pattern in a key level, you can go in. If you are selling, if you see head and shoulder pattern, you can go all in. While if you are buying, if you see head and shoulder pattern, you can buy. That's head and shoulder on the 15-minute time frame. You can go all in your entry zone. Make sure it's in your entry zone. So if you see head and shoulder pattern in your entry zone, feel free to go all in. So it is what it is, man. So let's go to the next one. So if you are taking 500 pip stop, which means if you are taking profit from, if you are taking your profit for 30 pip, your stop loss will be 10 pip. Let me say if you are selling and you are targeting 30 pip, your stop loss will be 10 pip. While if you are buying and you are targeting 30 pip or 40 pip, your stop loss will be 10 pip. While if you are targeting 300 pip, your stop loss will be 100 pip. If you are targeting 400 pip take profit, your stop loss will be 100 pip. So as so on and so on. So that's it. That wrap up the analysis of today. I will really appreciate you if you go in, if you go and hit that subscribe button, share the video, hit the notification bell, like, so whenever I drop a new video, you will be notified. So let's drop down to the downtrend and see how it plays out. So in a downtrend, in the Amos base form, in a downtrend is set to be drawn along the top. How do you draw a downtrend? Just like the previous example, a downtrend is said to be valid if it touches at least two pack or top. Simply means higher highs and higher lows. Let's give you an example right here. Let's say the trade start here, high, low, higher high. What has the market done? if the market came back into our entry and did what? I start going what? Up. So if I were to put a box right here, if I were to put a box right here, what has the market done? It come into our entry and did what? And did what? And start pushing down. You see, the market came into our entry, give us what we need. So at this point in time, yet what we are targeting is fund is 40 pip. We are targeting 40 pip at this point. Our stop loss will be 10 pip. Our stop loss will be 10 pip. As long as you are targeting 40 pip, your stop loss will be what? 10 pip. You see, that's it. It's nothing more than this. It's nothing more than what you see right here. You see the market did another thing like this. Trend start here, push into see trend start here, high, low, higher, higher, low. So if I were to put a box right here, the market came into our entry and did what? And start pushing down. So if from here to this high is 50 pip, our stop loss will be 10 pip stop loss. Our stop loss will be, so no, let's say 10 pip stop loss. So this is how we target it. This is how we target it. 10 pip stop loss. You get your profit and you get out of there. Simple as that. If you are targeting 100 pip, your stop loss will be, if you are targeting 500 pip, your stop loss will be 100 pip. If you are targeting 300 pip, your stop loss will be 100 pip. So it's very simple and it's easy for you to understand it. I don't know if you get it, but if you don't get it, you can go back and rewatch the video again for a proper clarification. Next is support and resistance. Right here, this zone right here we mark is the support. We mark the market pullback, gave us support and it was breaking to new highs. So right now the market came into our entry right here. This is the support right here. This is the support and this right here is the resistance right here. The market came into our support and did what? And blew off the resistance and did what? And keep going down. You see, that's the best way to identify support and resistance in the market. So this, once you draw your zone, you want to make sure the market come into your zone. And once the market come into your zone, you don't just want to trade. You want to get a confirmation, which is a pattern. Because if you drop down to the 15-minute right now to check that analysis right there, this right here, you say, okay, let's check it right there. You see what the market give us what an M pattern. The market come, you see, it come, did what? Give us M pattern and did what? And start pushing down. Are you seeing it? Let me delete this. Let me delete this. And did what? And start going down. And start going what? And start going down. So these are the things we want to see for us to make sure that this market is really going down and not just the double bottom. Next time we want to do more explanation on that. So let me just end it right there. Next time we will do much on that. However, that there is a place I'm going to right now, and I don't think there is enough time for all that. So I will just end the video here, and it is what it is, man. So you already know if you are selling right here, just like this previous example, If you are selling, you want your take profit to be below and you want your stop loss to be above. So you want it to be like 10 pip stop loss. So that's what you are targeting. 10 pip stop loss. Target it, take your profit. That's it. It is what it is, man. So yeah, good day and thanks for your time. God bless you. Let me check if there is another this thing I would love to pour out for you to hold with it, but for now, this is it. So let me check first. Next, I will really want to pour out is that after identifying trend, you want to make sure your confluences are clear with a trend line. You want to check where the direction of the market is going to, which direction this market is going to, which is trend line. Next is psychological level. That means you set your rules like this is where I want to go into the market and I'm not breaking it. If the market did not come to my entry, I'm not going in. That's what they call discipline. Third is self-analysis, support and resistance, which is the same similar thing. So yeah. And the third is candlestick pattern. You want to watch out for candlestick pattern if this market is in pattern or if this market is the head and shoulder. So you want to know which ways and how did you get into the market. You want to understand it. Are you getting it? So that's a wrap up the lesson for the day. So thank you for your time. Peace, love, and respect.